But we really wanted to highlight, as we said in the material we marketed, it's clear that the recession risk has increased. Markets are already reflecting part of that. Um, how is it different this time? So we'll look at some slides which looks at that particular aspect. It's also clear that global alliances have changed. You could argue maybe permanently, but they have changed seriously. So deglobalization, and that is something we're all unfamiliar with because we've enjoyed the benefits of globalization for the last, many decades now. And that brings with it a bunch of different risks and risks we haven't had to think about. We'll look at some of the headwinds facing particularly US assets, higher valuations and really high inflows into the US over the last decade. And we'll end up by kind of zooming out to kind of to reinforce what Alex has been saying. It's never as bad or as good as it seems. And if especially for those who have a longer time horizon, this can really be an opportunity. So let's get on to the first slide. Something I want to highlight is that even before, I'm just going to give me a second. I'm going to do this laser pointer. Okay. Even before, so April 2nd, around here is when the tariff announcement was made. This is GDP estimates done by the Atlanta Fed, very widely followed. You have seen a sharp deceleration already underway, well before the tariffs. I would argue because of the existing policy uncertainty, leading up to the big tariff announcement. So this is, partly why the markets are already down. When I say markets, think of the S&P 500. The markets are already down about 10% leading into the tariff announcement. And so, there was already some slowdown before the tariffs. What's happened since the tariffs? And we really value the betting markets rather than Wall Street forecasts, which seem to just be very trend following. I mean, none of the Wall Street firms were having any downside targets with the S&P. They were all raising the targets, leading into February because the markets had gone up so much. So here's where we were. This is the recession chances going up, the flip side of the earlier chart in February, as there was kind of more uncertainty with the administration's plans. And this red arrow here is April 2nd, right? You've seen this sharp increase. And so again, I don't think this is particularly surprising. I just want to show you what's happened with this is recession in 2025 probabilities. Bigger picture, both China and US have advantages and disadvantages. We will find out in the coming weeks who can stay the course longer. I would argue, I guess personally, I tilt to the side that when you're relying on a certain country for items, whether it's consumer items or essential goods, and you've got a 145% tariff, that's likely to hurt you more versus the country that's supplying it. But that really is open for debate. But we'll find out, and we'll discuss some of these tensions in the coming slides. I want to put this slide tries to put a historical perspective to this subject. I think we can all agree that trying to reduce the the trade deficit. I mean, the trajectory was unsustainable. So trying to reduce it is an excellent idea. Trying to also bring high-end manufacturing jobs back to the US, great idea. I think the problem is in the implementation and the policies. That's where the risks are, and that's where this debate is as well. And the markets are reflecting that uncertainty. What this chart shows you is manufacturing employment as a percentage of the overall labor force. And what I really want to highlight is that the downtrend started in the 1940s, accelerated in the 60s. There's a narrative that this was caused, the current problems are all caused by NAFTA, which is in 1994, and China's entry into the World Trade Organization, which is in 2001. No, I mean, that's factually incorrect. The one thing I can take from this chart is that in the last 15 years, the rate of decline has slowed. But other than that, it's, we're trying to undo some of the uh, perceived problems, but this has been a long-term trend, which has also led to a real growth in the wealth, overall wealth. We can argue that some of the negatives of this manufacturing decline has been unevenly felt. Everybody benefits from getting cheaper products from the benefits of globalization, but a smaller cohort of citizens are impacted by jobs being taken away. With this slide, I'm really trying to, it shows you last year's deficit, but what I want to highlight is the current narrative is, hey, we, the administration, we're speaking to 75 countries. We're going to go ahead and have these bilateral agreements in place. And now we're openly saying, yeah, like we want to corner China. I do not think that it's easy to have an effective bilateral agreement. We will sign bilateral agreements, but there's going to be a question of if it's going to be effective to actually bring jobs back and reduce the trade deficit. And that's because we already have a playbook in 2016 when we put tariffs in place on China. What you saw was large amounts of Chinese manufacturing moved to Mexico, Vietnam, Malaysia, and a bunch of other economies. So if you suddenly have a low tariff agreement with, let's say, Vietnam, why wouldn't more production that's currently sitting in China move to Vietnam? So I think that's where the difficulty is going to come. If you are going to try to do 5 deals over the next 3 months, I think I think there's a good chance you'd have a pretty good chance of successfully delivering that. When you tell me you're going to do 75 countries or 25 countries, these are really hard deals to put together. So I'm a bit skeptical that we will have effective deals. But we're in the markets. A deal, even if it's effective or not, will probably lead to a positive market catalyst in the short term, because the effectiveness will be felt, quarters and years down the road. Just keep that in mind. Um, this is the opposite of having trade deficits. So this is almost equal to the cumulative trade deficit that the US has run, because when you run a trade deficit, you're shipping dollars to the countries that are shipping you goods. And those countries generally, in turn, take those dollars and they buy US dollar assets. And so in 1990, the US owned as much overseas assets as foreigners own of US assets. Fast forward to today, this is totally lopsided. Foreigners own $26 trillion more than what we own overseas. This is a whole bunch of stuff. This could be, S&P stocks. It's $8.5 trillion of treasuries. When BMW invests in a car plant, that's concluded in this. Somebody buys a house, a foreigner buys a house in real estate. It's all lumped in there. But the fact is, when economic troubles happen, cash flows are weak, or due to geopolitical reasons, the foreigners can sell and take the stuff back. And so in the last 10 days, when there were wobbles in the treasury market, for example, there were speculation, I'd say, at this point. Oh, the Chinese are selling, foreigners are selling. I would say we will not really know that for several more quarters, because that's when the data comes out. But the fact that the US dollar weakened sharply over the last 2 weeks is probably a sign that, some money was, some of the assets sold here was taken overseas. I frequently get asked, especially from my finance friends, people looking in the markets, hey, is there a Trump put? Was there some level when the stock market falls, Trump's going to go, hey, no, we're going to change everything and go back to what it was before. Um, we've already seen some concessions, right? So in one sense, maybe there is a Trump half put that's already in play. My assertion or my view is that the stock market's not going to worry him. And he's kind of said that already. I think for a durable reversal of the current efforts will probably come with the approval rating or approval rating going down or the offset is the disapproval rating going up. So I keep a very close eye. I don't think you're going to see a sharp move anytime soon. You've already seen a pretty notable decline in the approval rating. You've had about 4 or 5 surveys come out that have been done since the April 2nd tariff announcement. Yeah, it's come down, but really, it's not that notable a change. Also, keep an eye on what happens with the budget debate because we're trying to extend a bunch of new tax cuts, and the main spending cut appears to be coming from targeting Medicaid. Um, Medicaid is currently enjoyed by there are 79 million beneficiaries. And if those benefits get cut, and this will be a second half event if it happens. So this will be a long, slow, drawn out decline if it was to happen. But this, I think, is really where any change, meaningful change, will come from, and not from the stock market moving up or down. A quick look at this. I apologize for the small lines and the writing on this chart, but the focus on the orange line that's come straight down, that is the current approval rating, is Trump's current approval rating. What's clear is relative to Biden and Trump 1.0, it's still pretty high. And in this current kind of polarized world we live in where narratives can be spun, the current spin is still like, hey, I'm doing really well, or the administration is doing really well, because yeah, it is true. It's doing much better than the last two administrations. So I think if it starts coming down towards 40% at this end of the gray line, I think that is when you'd probably start to see more Republican senators and congressmen who have to worry about the November 2006 election, where the kind of all-out backing for all these policies may start to waver. Again, don't expect anything in the next month or two. I think this is a 2 to 3 quarter, evolving situation. Switching now to kind of stocks and broader markets. This is a look at U.S. stock valuations. Focus on the orange line. This is the valuation. This is a trailing PE, price to earnings, how much you're paying in price to $1 of earnings. Yes, this year, over the last 2 months, you've seen a sharp deceleration or decline in the valuation. So it's more attractive today than it was, in February. But what is also noticeable is that from a long-term perspective, the trading range is just about getting into the top of the longer-term trading ranges. And so, they could go for it to become attractive. I'd say you need to come down to the middle, which is around 18 times earnings. And the other thing to watch out for is we still have very aggressive earnings growth projections. These are Wall Street projections for this year and next year. And if we do go into a recession, we are, especially 12.6 in 2026, these are definitely going to be at risk, because when the economy slows, earnings will naturally come off. Also expect the first half, both earnings and GDP to be strong, because you've seen fairly significant pull forward of consumption. We had retail sales come out today in the US, pretty strong, driven by purchase of cars. Hey, if you thought your car price was going to go up by, say 10%, heck, think even 5%, people rushed out and purchased cars. And so similarly, I think you're going to see a similar reaction of people buying stuff in April onwards, before, we don't know what happens exactly with tariffs, but, what happens in 85 or 80 days, given it's a 90-day reprieve. So this is one reason that I think there are headwinds for the US. This has been true for several years, as this chart itself shows. But maybe things are changing now, given what's happening with just economic growth and geopolitics. The second one is that part of the reason that US valuations were so high is that we had exceptionally large money come into the US. $1.1 trillion came into US stocks over the last decade. This is a chart to the beginning of the fourth quarter last year. Broadly correct. It hasn't changed dramatically since, and that's about 4 times more what the entire rest of the world got. And so I think it's common sense, if there is money to sell and take out, and particularly this profit, we had some amazing returns in the US over the last 2 years in 23 and 24. The benefits can also disappear, meaning as they go out, the capital, obviously that's puts the market and more at risk if there is a prolonged slowdown. Where did that money go? The money that came into the US go in the stock market? A very high concentration into technology. This is especially true after late 21, starting in about late 21. In 21, in the COVID rally, everything benefited. Then it's been a decline in kind of X technology. So again, one of the reasons we would expect a greater headwind in a prolonged slowdown period on US tech companies. So where might some opportunity be? And so just as much as money went into the US and away from international, the international markets, this is emerging markets versus US stocks. This is international developed versus US stocks. These are at multi-decade lows. And as you can see, particularly in EM, these are very cyclical. You've seen these, multi-year cycles. And, it's a little too early to say if this is happening for sure. I mean, in finance, I guess we never say for sure. But one of the takeaways is you don't need to rush. Right? Because if the trends reverse, because these markets are attractive and have not received money, but start receiving money now, this could be a 5 to 10-year view that you could take an area to outperform. And so it's something we're looking very closely because, many of the allocators in the US, are under allocated to international relative to the US markets. As Alex's slide pointed out, one of the few areas that's up year to date is the developed markets. Now, emerging markets is about flat, still much better than the US. So area we're really focused on. There was a reason, couple of things I want to get away from this slide. There was a reason for money coming into the US because profit growth was much better than the rest of the world. And this is a chart of US corporate profits. The other thing I'd like to point out is one of the drivers, and we don't know exactly how much, one of the drivers of this, pretty impressive growth in profitability is the productivity that has come from offshoring globalization. You do it because it's lower cost, makes it, leaner supply chains, etc. So now if we're trying to really fundamentally re-alter the global trading system and global trade comes down, I think it would be fairly sensible to assume that margins have downside risk as well. And that is currently not priced into, or it's not in the estimates that I showed you earlier, which I thought were too high. So, here's another kind of concrete area where if trade goes down because of tariffs, you're probably going to see a headwind to margins as well. Switching over to bonds. This is high yield or junk bond credit spreads. Credit spread basically means how much more in interest or yield you're getting from owning a high yield bond versus a similar tenured US Treasury. Um, it's gone up over the last month from but from very almost near historic lows. So to us, with the higher probability of a recession, and in recessions, you've seen, the spreads go up to, closer to 7.5, 7.5, and we're only at about 4.5. This is an area we still don't think there is value. The risk reward is not that favorable to us. Um, and two last slides, but one of the things that has really cropped up and has really been an issue over the last 2 weeks when stocks sold off. Typically, stocks when stocks sell off, bonds. When I say bonds, in this case, treasuries, especially longer term treasuries, rally. So in this period where this black and the green line is in the negative area, this is what you build a typical 60, a naive 60-40 portfolio where, hey, when your stocks fall, bonds go up and your portfolio volatility is lower and it makes for better long-term return outcomes. What you've seen since inflation's picked up is that the correlation is very high. So when stocks fall, bonds fall as well. So that cushioning effect is no longer there. We build bond ladders owning individual bond for client portfolios to match their future income needs. That is totally fine. But if you're naively got a 60-40, 70-30, 80-20 portfolio based on this lower correlations of the past, it's something you might want to rethink. And this ties back to potentially foreigners owning $26 trillion, geopolitics being pretty bad. What if they start? I mean, they're not going to head out in all one go, but all you need to do is, make slight changes that you may see this correlation stay high, and it's not something you want to see for your portfolio. Second to last chart, it always pays to, in times of stress like this, humans do not make good decisions when we're stressed out. Pan out. And to the extent you have a longer time horizon, stocks have had the amazing ability to adjust to a whole host of threats and opportunities globally. Like bonds can't do that. It's what's called fixed income because you just get that fixed income. US stocks in particular, given the dynamic US economy, have adjusted. We've gone overseas. We, get a lot of overseas revenue now. What Alex and I are really trying to focus on, is there being a handful of occasions, the tech bubble, 2007 and 8, and then in 1970, where you've had a decade of poor performance from US stocks. And, we're trying to make sure that we aren't at one of those moments where, by owning something else, maybe bonds, maybe international, maybe gold, we will do much better for our client portfolio. So that's really where I'm spending a lot of my time thinking about it. No clarity at the moment. Clearly some headwinds that we have not seen in the last several decades. And so we're alert, and that's what I'm focused on. Last slide. This is concluding and our top investment ideas. So we started off by saying this downturn is likely going to be different. And one of the key issues is that tariffs are going to be inflationary. Therefore, the Fed's ability to lower rates into a slowdown is going to be curtailed. And think about 2020, think about the GFC. The Fed came in, provided lots of liquidity and printed money, and asset markets did well. We're probably at the first instance going to be curtailed, and so no Fed support or limited Fed support. The other part is fraying geopolitics. We've had allies in particular consistently buying, taking those dollars that they get through our trade deficit and buying US assets. Now, as trade slows down, they're getting fewer dollars. And maybe because growth overall is slow, they need to trim some of their holdings. That's how China can defend the yuan, which is already weakening. They may be selling some. We won't know for certain for a few more quarters. So at the moment, it's all speculation by anyone who says they know for sure, because we don't know for sure. Uh, on the US stock side, we already talked about it. We're still at high valuations, particularly in kind of the tech sector, the growth sector. We have really benefited. The US stocks have benefited over the last decade from $1.1 trillion of inflows. So the probability, if there was a prolonged slowdown, is that what would you sell is the stuff where you bought, which is the US. I would say, reiterate what Alex was saying. On the safer side, sectorally, consumer staples, utilities, telecom. More exposed will be tech because of geopolitics. About 50% of tech earnings comes from overseas. Pharma, because President Trump is targeting pharma for tariffs. And then consumer discretionary, because we, manufacture most of it overseas. Small and mid caps are pretty cheap, have been for the last several years, but always more exposed to recessions, and so we continue to remain underweight there. On the fixed income side, we see risks from both inflation but also recession. So we want to have a balance between TIPS, Treasury Inflation Protection protected securities, short-term treasuries, and intermediate-term treasuries. We don't like the volatility of owning longer-term securities, which fluctuate as much as the S&P 500. We continue to avoid junk bonds. We already looked at international stocks. We have gradually increased allocation. We're watching very closely. It is underallocated. If people just get up to a market weight, I think there's probably lots more upside to go. There is no need to rush, because if this is a trend, it's probably going to be, if it's durable, we're going to look at potentially multi-year outperformance versus the US. And with the final point would be with changing geopolitics and what you've seen, the high stock bond correlation. I mean, in this sell-off, the only mainstream asset that has actually gone up, not, stayed flat, is gold. It's proven itself over the last 2 years. It's proven itself over centuries of usage. And it definitely holds value in the portfolio. I also think that Bitcoin has essentially the same qualities of gold and some other parts, but it's much more volatile. But it should be in the conversation, obviously with much lower allocation because of volatility. So I want to end there. I look forward to having the questions.
Oh, yeah.
If you need to contact us in the future, our details are here. I will let Alex, and thank you for those of you who posed some questions when you signed up.